Welcome to Iron Financial. This is the only place where we forge stronger portfolios by cutting right through the market weakness. I'm your lead analyst. Today, we're putting Advance Auto Parts, ticker AAP, on the anvil. Now, the company just dropped its full year 2025 earnings, and yeah, the stock has been on a tear. But our job isn't to just follow momentum. It's to hammer out the cold, hard facts and see if this company's framework is actually built on solid steel, or if it's rusting from the inside out. Let's get to work. So here's the central conflict we really need to resolve today. On one hand, you've got a stock that has rallied, and it's catching the eye of a lot of investors who are desperately looking for a comeback play. The headlines? They're screaming about a profit swing, an optimistic outlook. You know the drill. But then, when you pop the hood and look at the engine, you see some pretty serious warning lights flashing. This is that classic market battleground, a compelling narrative of a strategic turnaround clashing head-on with some very, very harsh underlying numbers. Our mission is to dig in and figure out which side has the structural integrity to win this fight. Is management actually building a fortress, or is this whole thing just a house of cards waiting for the next gust of wind? All right, we're going to deconstruct this company methodically. There is absolutely no room for guesswork here. First, we're going to look at the official story, the CEO's turnaround blueprint. Then we'll stress test the top-line revenue, and believe me, it needs stress testing. After that, we'll dive deep into the margin expansion story, because that's the real core of the bull case. But then, we look for the weak points, the cracks in the foundation, focusing on cash flow and debt. We will scrutinize the 2026 guidance to see if their blueprint for the future is even credible. And finally, we will deliver the iron verdict. Let's begin. Okay, let's dive into the bull case. To understand why anyone is buying this stock, you have to start with the company's own narrative. See, every turnaround story needs a leader and a plan. For Advance Auto Parts, that's their CEO, Shane O'Kelly. He's been tasked with the heavy lifting of restructuring a business that, even by his own admission, needed a totally new foundation. The entire bull thesis, every last bit of it, rests on the idea that his strategic plan is not just talk, but that it's actively reshaping the company for real, sustainable profitability. And this quote right here is the cornerstone of that narrative. This is pulled straight from the earnings release, and it's the official position. Now, words like foundation, progress, and commitments, they're chosen very, very carefully. They're meant to instill confidence that all the pain of 2025, the store closures, the big restructuring charges, was all part of a deliberate, necessary process. This is the promise to investors. We've cleared out all the debris, and now we're finally ready to build. That's the promise. But as we know, a foundation is only as good as the ground it's built on. So let's go ahead and test that ground.
Right. It's easy to talk about building a great foundation. It's a whole lot harder when you find out you're building it on a shrinking piece of land. The CEO's vision sounds compelling, sure, but vision doesn't pay the bills. Revenue does. So before we get carried away by all these promises of future profits, we have to look at the most fundamental metric of any business, period. Are people buying more of your stuff or less? Let's look at the hard numbers.
And here it is, $8.6 billion in net sales for fiscal 2025. On the surface, it's a massive number. But in our line of work, a number in isolation is just noise. It tells you nothing about momentum. It doesn't tell you if the business is healthy or if it's sick. To find the signal in the noise, you have to ask one simple question. Is that number bigger, or is it smaller than last year's? That's where the real story begins. And here is the context that really matters. In 2024, the company brought in $9.1 billion. In 2025, that number fell to $8.6 billion. That's a $500 million drop. That is not a rounding error. That is a significant contraction in the business. So while the CEO is talking about building a foundation for the future, the company's actual sales footprint got smaller. A $500 million in revenue just vanished year over year. Now, the argument from the bull camp, and what the company is going to tell you, is that this is a strategic shrinking. They'll say they're optimizing their footprint, closing underperforming stores to focus on the more profitable ones. But let's be crystal clear, a dollar of revenue is a dollar of revenue. Optimizing is one thing, but at the end of the day, the company is bringing in less money than it did a year ago. You can call it strategic all you want, but it's still a decline. The crucial question is whether they can actually find enough profit in a smaller business to make up for all that lost ground. And that leads us directly to the margin story. Exactly. And this is where the bull case really gets its strength. The argument is that top-line revenue isn't the whole story right now. The real heavy lifting, they say, is happening on the expense side. The whole turnaround plan is designed to make every single dollar of sales more profitable. So while the company may be getting smaller, the bulls argue it's becoming a much leaner, more efficient machine. The evidence for this is found in one place, the operating margin. Let's look at the progress they've made. And here it is. This is the heart of the entire turnaround narrative. Just look at the magnitude of this change. In 2024, for every single dollar in sales, the company was making just 0.4 cents in adjusted operating profit. That's razor thin. I mean, that's basically a break-even business. Fast forward 1 year to 2025, and that number jumps to 2.5 cents. That is a massive expansion of over 200 basis points. This isn't some small tweak, it's a fundamental shift in the company's profitability profile, and it is the single most powerful piece of evidence the bulls have that the CEO's plan is actually working.
So the big question is, how did they pull this off? Well, it wasn't one single thing. First, that big restructuring plan and the footprint optimization, closing those hundreds of stores, that directly lowered costs. This led to lower selling, general and administrative, or SG&A expenses. They were also cycling some very large atypical charges from 2024, which makes the year-over-year comparison look really favorable. Add in some improvements from strategic sourcing for their products, and the simple fact that they were operating fewer, more profitable stores. It's a multi-pronged approach to cost-cutting, and on this front, you have to admit, they've delivered. But there is always a but. And here is the but. That little word, adjusted, is doing a lot of very heavy lifting here. Let's look at reality without all the adjustments. According to generally accepted accounting principles, that's GAAP, the official rulebook, Advance Auto Parts didn't have an operating income of $216 million. No, it had an operating loss of $43 million. The adjusted earnings per share they promote is $2.26. The official GAAP number, just $1.13. The company is literally subtracting hundreds of millions in expenses for things like restructuring just to get to these positive adjusted numbers. So the real question for any serious investor is this: are these restructuring costs a one-time thing, or are they the real ongoing cost of trying to fix a broken business? That is the perfect transition, because adjusted income doesn't pay for inventory or keep the lights on. Cash does. So now we move away from the story the company wants to tell, and we get into the hard, cold reality of the cash flow statement. This is where we see if the foundation they're building is truly solid or if it's already showing some deep structural cracks. Let's follow the money. Forget adjusted profits for a moment and just look at this number. This is free cash flow for the full year. It's not positive, it's not zero, it's negative $298 million. This is a massive, massive red flag. It means that after all the cash that came in and all the cash that went out to run the business and invest in itself, the company had a shortfall of nearly $300 million. They are burning cash at a very significant rate. A company cannot survive doing this indefinitely. It's just not possible. So where did it all go? Well, this isn't a simple story. First, net cash used in actual day-to-day operations was negative $46 million. So the core business itself was burning cash before anything else. On top of that, they spent $252 million on capital expenditures, investing back into the business. And then, buried deep in the details, we see the real cost of that adjustment we just talked about. About $140 million in cash went out the door for restructuring charges. This isn't some non-cash accounting trick. That is real money spent to close stores and reorganize the company. The cash burn is literally coming from all directions. So, if you're burning through hundreds of millions in cash every year, how do you plug the hole? You take on debt. At the end of 2024, the company had about $1.8 billion in long-term debt. A year later, that number has ballooned to $3.4 billion. They have nearly doubled their long-term debt in a single year. This is a critical point. While they're shrinking the top line and burning through cash, the financial risk on their balance sheet is increasing dramatically. This is not a sustainable formula. And this number right here, 522, ties it all together. The 522 net store closures. Now, from the analyst perspective, this is a necessary evil. You have to cut off the dead limbs to save the tree and improve profitability. But from a skeptic's view, this is the engine behind the cash burn. Those $140 million in cash restructuring charges, that's the direct cost of these closures. The $500 million in lost revenue, that's the direct consequence of these closures. There's a saying, you can't shrink your way to greatness. Closing stores can temporarily boost margins, sure, but it can also be a sign of a business that's in terminal decline. And right now, the jury is still out on which one this is. That is a powerful indictment of the past year's performance. But the market, as we know, always looks forward.
The bulls will argue that all this pain, the cash burn, the mounting debt, the closures, was a necessary investment to build a stronger future. The real test is whether that future actually looks any better. Management has given us their blueprint for 2026. Let's see if it holds up to any real scrutiny.
Okay, here's the roadmap they've laid out for 2026. As the analyst, I'm focusing on two key lines here. First, adjusted operating margin is guided to expand again from 2.5% in 2025 up to a range of 3.8% to 4.5%. That's continued substantial progress on profitability. Second, adjusted EPS is guided to rise from $2.26 this year to a range of $2.40 to $3.10. That's earnings growth. This is what the bull case is all about. But hold on. Look at the very first line. Net sales. The high end of their guidance is $8.58 billion. Remember what their sales were in 2025? $8.6 billion? So even in their most optimistic scenario for next year, they expect to bring in less revenue than they did this year. They are guiding for another year of shrinking sales. How can you possibly be a growth company if your official plan is to shrink?
And that right there is the billion-dollar question. That tension between shrinking sales and expanding margins, it defines the entire investment case for Advance Auto Parts. So now it's time to put it all together. We've hammered on the numbers from both sides. We've examined the bull case, and we've exposed the cracks in the bear case. It's time to lay it all out on the table and deliver the iron verdict.
So the crucial point is this. The bull case, my case, is built on a foundation of execution. The CEO has a clear plan, and he is delivering on it. We see strong, absolutely undeniable margin expansion. We see a return to positive comparable store sales growth, which is a key forward-looking indicator. And the guidance for 2026 shows continued progress on both margins and earnings per share. This is a classic turnaround story in motion. From the bear's perspective, however, this isn't a turnaround at all. It's a controlled demolition that's being masked by accounting tricks. The foundation isn't being rebuilt, it's crumbling under the weight of new debt while the business itself shrinks. You have declining year-over-year revenue, and you have guidance for another decline next year. You have a massive, undeniable negative free cash flow of nearly $300 million. You have long-term debt that has nearly doubled in a single year, and the entire profit story relies heavily on these adjusted figures that just so happen to paint a much rosier picture than the official GAAP reality.
So we leave you with this final question. Do you believe in the blueprint? Do you see a high-torque turnaround that's really gaining traction, where a leaner, more profitable company emerges from all this restructuring? Or do you look at the fundamentals, the shrinking sales, the cash burn, the soaring debt, and conclude that the engine is still leaking oil, and the repairs we're seeing are just cosmetic? We've laid out the facts from the source material. The final verdict, as always, is yours to forge. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.